Welcome to the deep dive. This week, we are entering a market driven not by loud events, but by a chilling silence.
Hmm.
We're dissecting the crucial 5 days between November 10th and 14th, 2025. It was a period defined entirely by the absence of information.
Total vacuum.
Exactly. And we're cutting right to the core analysis today using these really specific LoopMarket documents from Devin McClarty. They're produced by D Investment Enterprise, published through D Publishing Group.
Fantastic source for this.
For you, our listener, you need quick, targeted knowledge. So our mission is to break down how this information void wasn't really a vacuum at all, but an active market catalyst.
That is absolutely the central insight here. When we look at this week, the driving force was what they call the information void.
Right.
It was the total shutdown of official government data, all because of that 6-week government shutdown. And this void, it didn't just slow things down. It forced the entire market into a defensive, risk-averse posture almost immediately.
So the lack of information became the information.
Precisely. The lack of reliable input became the single dominant driver of how assets were being valued.
Okay, let's unpack this. I mean, markets have endured shutdowns before, right?
Yeah.
Sometimes for longer. Why was this information void so immediate and critical that it stopped trading in its tracks?
That's a great question.
I mean, don't sophisticated investors have private sector proxies they could look at? You know, ADP data, industry surveys, things like that.
They do, but those proxies, they just aren't enough when the stakes get this high. You're touching on the real structural issue here.
Okay.
For accurate risk assessment, especially around big systemic things like inflation or labor strength, markets rely on federal data. We're talking labor reports, productivity figures, CPI.
Bedrock.
That's the word, the bedrock. So when that stream is cut off for 6 weeks, institutions lose their ability to accurately project growth or pricing pressure. The market can handle bad news. It cannot handle unknowable risk.
So the McClarty documents, they actually categorize the anxiety here into 3 interlocking factors. The first one is pretty clear, the catalyst.
Yeah, the shutdown itself.
Simple cause and effect. The government shuts down, critical reports stop coming out.
Right. But the next 2 are where it gets psychological,
Okay.
and they compound. The second is the investor reaction.
Which is what? Just
Basically,
right.
if you lack the ability to confidently price risk, the institutional default is just to reduce exposure. It's a defensive posture. Sell now, figure it out later. They were prioritizing liquidity over getting a better yield.
And it was that third element, the compounding factor, that really sealed the deal. Because it wasn't a total data vacuum, was it?
No, not ton.
The limited private sector labor data that was trickling in, it actually reinforced the fear. It showed a rise in layoffs.
Precisely. That limited, weak data, it just acted like an echo chamber. It confirmed everyone's worst fears that the economy was slowing down just as our main source of visibility was, switched off.
So the uncertainty became an active, quantifiable liability, something capital had to get away from.
It had to be shed, yes.
Here's where we move from the theory to the proof. How did this active uncertainty translate into actual numbers that week, November 10th through the 14th?
Well, we saw a really acute and divergent weakness across the major indices, and it highlights exactly where institutions saw the biggest risk.
Okay, so the core data shows the broader S&P 500 fell approximately 1.6%.
Manageable, you could argue.
Manageable, perhaps. But the NASDAQ fell almost twice as hard, down approximately 3.0%.
And that divergence is the smoking gun. The McClarty analysis calls it valuation de-risking.
Valuation de-risking. Break that down.
Think about it. The NASDAQ is just stacked with high multiple tech stocks, speculative AI companies. Their valuations depend heavily on smooth, uninterrupted future growth.
Which you can't project and avoid.
Exactly. When uncertainty spikes, those projections become impossible to trust. So investors sell those growth stories first, and that just accelerates the valuation compression in the riskiest assets.
The divergence clearly shows institutions were just running from growth. But this wasn't only an equity story, was it?
Not at all.
The analysis points to broader cross-asset confirmation. This was a global flight from risk.
Absolutely. The really powerful corroborating evidence came from digital assets. Bitcoin, which is often treated as a risk-on barometer by a lot of funds.
Right.
It fell below the critical $100,000 psychological threshold.
Wow, that is a huge number. Was that just psychological, or did crossing that line trigger actual automated selling models, like a fundamental break in confidence?
I think it was both. $100,000 was a massive technical and psychological level. Breaching it triggered broader global deleveraging. It showed the problem wasn't just in traditional stocks.
It was everywhere.
It signaled a widespread, systematic effort to shed perceived risk across all asset classes, from tech stocks to crypto.
Okay, this sounds intensely fearful. But if it were full-blown panic, you'd expect a messy flight into cash, maybe severe instability in government debt. Did we see that?
Not entirely, and this is a really key nuance. The 10-year Treasury yield stayed relatively stable. It was hovering around 4.14%.
So, not panic.
That is the signature of a methodical flight to safety. Investors were hiding in high-quality debt, but it wasn't a manic, disorderly dash that would signal a collapse of faith in the whole system.
That distinction, methodical, not manic, that sets the stage perfectly for where the money actually went. If the NASDAQ was the source of the flight, the sector rotation tells us the destination. What were they looking for when they repositioned their capital?
They were looking for something called a liquidity premium.
Meaning?
When clarity disappears, capital flees potential high growth for absolute predictability and strong, immediate cash flows. The goal was just to find shelter. It's the classic textbook defensive rotation.
Let's review the sector performance from the McClarty documents. It really shows that defensive positioning. Who are the clear outperformers, the safe harbors?
Utilities, which is tracked by XLU, and healthcare, XLV.
The non-cyclicals.
Exactly. People always need light, water, and medicine no matter what the economy is doing. Their cash flows are predictable. That makes them low-risk havens.
And we saw consumer staples, XLP, and financials, XLF, as neutral performers, so stability there. But the sharpest pain was felt by the underperformer sector.
Information technology, XLK. It suffered the deepest drawdown by far.
So this strategic repositioning, it just confirms the market is pricing in a long period of ambiguity?
It is. Institutions are actively prioritizing stability over promised growth. They're accepting lower returns right now in exchange for much lower fundamental risk.
Okay, now we move to maybe the most nuanced part of the McClarty analysis, this proprietary framework they call structural intelligence. This isn't just counting the losses, it's trying to diagnose the collective mindset of the market.
Yes, and it's so important because it allows us to distinguish between rational and emotional behavior. The surface data, that 3% drop in the NASDAQ, looks scary.
It does.
Structural intelligence provides the internal diagnostic, and the core interpretation from this framework for that week in November is definitive. It says, this is unpriced uncertainty, not panic.
Okay, explain to me why that distinction matters so much to an active trader. How does unpriced uncertainty change your strategy versus just panic?
Panic is irrational. It leads to indiscriminate selling, fire sales, asset correlations collapsing. Uncertainty, even unpriced uncertainty, suggests rational actors are making calculated moves based on incomplete data.
So you avoid the high-risk stuff, but you protect your core stable holdings.
You got it. And to confirm this, we look at the specific indicators within the structural intelligence framework.
Okay, let's break those down. What do they measure, and why did their movement confirm this calculated caution?
So we analyzed 4 key factors. First, the CCI, or dependence. It measures how reliant the market is on external guidance or data. This was weakening. It was pointing down.
Meaning the market felt like it was operating without a map?
Without a map. Second, the IDI, or design. This measures the market's certainty in long-term economic planning. This was also uncertain, pointing down. Investors lost faith in the clarity of the future.
So 2 indicators confirming a serious loss of clarity and guidance. Why didn't that translate directly into panic?
Because of the other 2 factors.
Yeah.
Critically, the DDI, or faith, was neutral. It was flat.
And DDI measures what?
It measures long-term systemic confidence, the belief that even though things are messy right now, the underlying financial system won't collapse. Its neutrality is the single strongest counterindicator against a panic narrative.
That makes perfect sense. The structural conviction holds, even if the daily guidance is totally missing.
Exactly. And the 4th factor, the VFI, or behavior, showed a rotating defensively.
Yeah.
A shift. It wasn't chaotic, indiscriminate selling. It was a strategic, organized shift from growth sectors into defensive ones.
So if we connect this all to the bigger picture, this framework confirms that the defensive rotation and the selling pressure, they were calculated. They were methodical.
A rational risk aversion to the data constraints.
Not a full-scale, fear-driven panic. Investors were acting intelligently in the face of an irrational information blockage.
It suggests the participants were sophisticated enough to see the risk inherent in the void itself, and they took immediate, measured steps to mitigate it, rather than just reacting emotionally.
So we've journeyed from the initial absence of data through that index divergence and the sector rotation into stability to this final diagnosis from structural intelligence.
And the central finding for you to take away is mastering that crucial difference. Unpriced uncertainty is a methodical, calculated response to a known lack of information.
Right.
Panic is a fear-driven, irrational response where systemic confidence just collapses. The McClarty documents definitively show the November market was firmly in the first camp, methodically protecting its capital.
And that leads us to our final provocative thought. Given that the source documents characterize this as a defensive, calculated response, what fundamental shifts would need to happen in those proprietary indicators, specifically the DDI, faith, and the VFI, behavior, for the market to move from that calculated, unpriced uncertainty into actual, full-scale, fear-driven panic?
Something to reflect on.
Something to reflect on as you continue navigating these complex market signals. We look forward to the next deep dive.